Welcome to the Deep Dive, the place where we distill complex source material into insights you can actually use.
Hey there.
Today, we're getting into something pretty fascinating. It's the measurable way that our collective emotion on social media, especially the negative stuff, doesn't just nudge the stock market, it can actively drive it.
It really is just a high-speed, modern version of a very old game. I mean, as soon as information existed, people have tried to use it, to manipulate it for financial gain. You only have to go back to the 19th century.
Oh, absolutely. The Great Stock Exchange Fraud of 1814, the one with Lord Cochrane.
That's the one.
He just puts out this fake story that Napoleon had been killed, British securities go through the roof.
And he cashed out right at the peak of the panic.
Exactly.
Right.
So whether it's 1814 or today, the principle is the same. People act on information, they seek premiums, they accept risk, often without even checking if it's true.
And the main difference now is just the unbelievable scale and speed.
Right. The new battlefield is social media. X, formerly Twitter, has completely erased that gap, that time lag between what a customer says and what a company hears.
Every voice is instantly part of this huge market conversation.
So our mission today is to track the evolution of a very specific methodology. We're looking at a series of papers from Ramon Alejandro Mendoza and his collaborators.
And it's a really fascinating journey. We're going to see how they went from just proving this effect exists in a really small sample to measuring its influence across, 85% of the entire U.S. stock market, down to the hour.
Okay, so let's start at the beginning, the foundation. Because before you can measure how big something is, you first have to prove what shape it is.
Mm-hmm.
The first studies, back around 2021, 2022, they were really rooted in behavioral economics, right? Specifically, the idea of loss aversion from Richard Thaler.
That's it, exactly. The first question was just, is this impact symmetric or is it asymmetric?
In simple terms, does a bunch of bad news hurt a stock more than the same amount of good news helps it?
Right. Loss aversion would suggest, the negative hit is going to be way bigger. The pain of losing is stronger than the joy of winning.
So how did they even begin to test that?
They started small, but really deep. The first sample was just 24 of the world's biggest, most visible companies. But, and this is key, they pulled data over a huge time frame, a full decade, from 2009 to 2019.
And they only looked at the top 1% of comments mentioning the company tickers. Now, hang on a second. If you only look at the top 1%, isn't that just a feedback loop? You're just confirming what the loudest, maybe the most extreme people are saying.
That's a great question, and it's why the method had to be so sharp. They used AI and natural language processing, NLP, to classify this high-impact chatter. It wasn't just counting tweets.
Okay.
They were creating these distinct positive and negative sentiment indexes to try and isolate the most powerful signal.
And to prove causality, that the sentiment was pulling the price and not the other way around, they used two pretty heavy-duty statistical tools.
Right, transfer entropy and GARCH models.
Okay, transfer entropy. Let's break that down.
TE is basically a signal tracker. It measures the information flux, the direction, and the strength of the signal traveling between that social media sentiment and the stock's returns. It tells you if the tweets are pushing the stock.
Got it. And GARCH, that sounds incredibly academic.
It is, but what it does is pretty simple to grasp. It helps you measure the different sizes of the panic versus the euphoria. So if transfer entropy proves the signal is moving one way, GARCH proves the intensity is unequal.
Yeah.
It's the tool that confirms the panic button is, way bigger than the celebration button.
What did it all show?
The findings were really consistent. They totally supported that asymmetric effect. The negative sentiment index was influencing stocks much more frequently than the positive one.
And the intensity.
The GARCH models confirmed it. The impact of negative news was way bigger, and sometimes it would even linger for 2 or 3 days. The fear had legs.
So the mechanism is real, it's quantifiable, and it's biased toward fear. Okay. But proving it works on 24 giant companies over a decade, that doesn't really help a portfolio manager who's trading the whole market in real time.
Exactly. And that brings us to the next big leap, around 2023. This was all about scaling up and speeding up.
Taking it from a small pond to the entire ocean.
That's exactly the challenge they took on. The scope just exploded from 24 companies to 2,557, which represents about 85% of the entire U.S. equity market cap.
Wow. And the data strategy must have had to totally flip. You can't wait 10 years for the data.
No way. So they did the opposite. Instead of the top 1% over a decade, they pulled the entire universe of comments they could get. About 50 million tweets, but over a really short, high-frequency period of just 4 months. The goal was speed.
And if you're shifting from daily closing prices to hourly observations, you have to be so careful about proving causality. How did you make sure the tweet always came before the market moved?
This is where the methodology got really clever. It's a huge data problem. If you have an hourly return, you have to be 100% sure the tweet was posted before that hour closed.
Right. A tweet at 3.17 has to be linked to the market's move after 3.17, which seems obvious. But with millions of data points, timing must be a nightmare.
It is. So they used what they called a precise causality correction. They aligned all time zones, UTC to EST, perfectly. And then they used this simple but brilliant trick. Ceiling hour rounding.
Ceiling hour, what's that?
So if your tweet comes in at, say, 15.17 EST, they don't pair it with the 3 p.m. return. That period has already started.
If it could be contaminated.
Exactly. So they round it up to the next full hour. That 15.17 comment gets paired with the 16-point years, the 4 p.m.
Oh, that's smart. That's a really clean fix. It just guarantees the market hadn't moved yet. The tweet came first.
100%. It solidifies that the sentiment is the driver, not the echo. And it also helped them deal with a massive data sparsity problem.
Right, because when you go from 24 huge companies to thousands, most of them probably have, like, 0 social media presence.
Total silence. So they developed a clustering and imputation technique. Basically, filling in missing data up to 30% of it with smart averages. That let them keep 556 companies in the final clean analysis.
So after all that heavy lifting on the data,
Yeah.
what did they find? How fast is this signal?
It's fast. The method proved the signal travels from social media to the stock market in under an hour.
Under an hour. That is lightning quick.
It confirms that you absolutely need high-frequency analysis for this stuff.
And the asymmetry.
Yeah.
Did that 24-company finding hold up when they scaled it to the whole market?
It held up, and it got even more intense. This is really the mind-blowing part of that study.
Okay.
Even though the raw volume of positive comments was, on average, 4 times bigger than negative comments.
Which makes sense. People are generally neutral or positive.
Right. But the negative comments still carried this enormous weight.
How enormous are we talking?
Using the GARCH models on that huge new data set, the impact of negative comments was found to be nearly 10 times greater than the positive ones.
10 times. Wait, hold on. So one person posting 5 really negative, angry comments can basically cancel out 50 positive, slightly promotional comments.
That's the math. It's an incredible validation for loss aversion. It shows that fear, as a market force, is just exponentially more powerful than enthusiasm or hype.
It also means if you're just counting total mentions, your data is completely misleading. You have to separate the negative and then give it a huge weighting factor.
That's the bottom line.
Okay, so you've proven the speed is under an hour and the negative multiplier is 10 times. But for a theory to be truly robust, it has to hold up under extreme stress.
It has to survive a real panic.
Which brings us to the ultimate stress test. The more recent work applying this exact model to the 2023 regional banking crisis.
Yeah, a sudden market shock like the Silicon Valley Bank failure is the perfect laboratory. So their research zoned in on 167 publicly traded U.S. banks to see how the sentiment contagion spread.
I'd guess that most regional banks have almost no social media chatter until they're in the news for failing.
Exactly. Massive data gaps. We're talking up to 65% of the data was missing at the individual bank level, so the team had to adapt the methodology again.
How?
They developed what they called an industry-aggregated sentiment model.
So how do you get a full picture when most of the individual data points are just blank?
It was a pretty smart bottom-up approach. They calculated the sentiment score for each bank that had data, but then they weighted each score by that company's market capitalization.
So the bigger crisis-hit banks have more influence on the overall sector score.
Precisely. It lets you capture the overall mood and performance of the entire sector, even if most of the smaller players are silent.
And did the chart? Did it actually show the crisis unfolding?
It was a perfect mirror. You could just see the panic in the data. The market cap-weighted performance for the banking industry just falls off a cliff in March 2023, and it lines up exactly with the change in the mood.
What was the change?
Well, before the crisis, the ratio was about 7 positive comments for every 1 negative one, a healthy 7-to-1.
Pretty normal.
But during the peak of the crisis, that ratio dropped sharply, down to 3-to-1. And here's the crazy part. Between March 9th and March 21st, the ratio actually inverted.
Meaning negative comments outnumbered positive ones for the first time in their data.
Yeah. That isn't just noise anymore. That is the sound of collective financial panic.
So what did the modeling show this time? They used a different tool, right?
Yeah.
A vector autoregression. VAR.
Right, VAR analysis. And it gave them two key insights about persistence.
Okay, what does VAR do for us here?
Think of it like a high-tech traffic camera for data. It tracks how fast signals are moving and how long the resulting traffic jam lasts, but in both directions, from the market back to social media and from social media to the market.
And what did the traffic report say?
Well, it did confirm bidirectional causality. The falling price made sentiment worse, and the worsening sentiment made the price fall further. That makes sense in a crisis.
A feedback loop.
A feedback loop. But, and this is the key finding, the analysis showed that the sentiment had a significantly greater and more sustained impact on the performance than the other way around.
How sustained?
So the biggest negative hit happened, again, within that first hour, but the signal kept influencing stock performance, sort of oscillating, for up to 33 hours later.
33 hours, wow.
Uh-huh.
So the market has this violent, immediate reaction, but the negative emotional echo just keeps bouncing around for more than a full day, driving these little aftershocks.
It proves that in a crisis, that emotional feedback loop is incredibly durable. It just hammers home why you need this real-time, high-frequency, weighted analysis.
I mean, this whole progression is really a perfect example of how research should evolve. You start with a small, deep, decade-long sample to prove a basic theory asymmetry using transfer entropy. Then you scale up to a massive hourly sample to prove the speed under an hour using GARCH models. And finally, you apply it to a live crisis to prove the persistence up to 33 hours using VAR.
The evolution is just so clear. They started by guessing this asymmetry existed based on economic theory. They ended by quantifying that 10x multiplier with a high degree of certainty. It's a quantitative validation of loss aversion. Fear moves the market.
So for the listeners, for the portfolio managers or regulators, what is the single biggest actionable takeaway from all this?
The takeaway is that this isn't about counting all your tweets or calculating some simple net sentiment score. It's about building filters. Real-time filters that prioritize negative sentiment by a factor of 10 and basically treat most of the positive chatter as secondary noise.
But if you want to predict volatility and returns,
you have to watch that negative index like a hawk, especially in the first hour of any market event.
it makes the job much clearer.
Yeah.
Focus your computing power on the fear. Okay, so last question. Where does this research go next? What's the next frontier?
Well, the researchers themselves have suggested the next big step, and it's segmenting the data by user type. Right now, a negative comment is a negative comment. But what if you separated them? Does an angry customer have the same market impact as a famous influencer? Or a competitor? Or just a persistent troll?
That's a great point. Figuring out if different groups have different levels of influence, that would be the next logical step in mapping out the true flow of this asymmetric power.